Hello everyone, and thank you for attending today's Brightstar Resources Investor Briefing webinar. My name is Lucas Robinson of Investor Relations Consultancy Corporate Storytime. Brightstar Resources is a West Australian-based gold production, development and exploration company. Brightstar has recently announced a definitive feasibility study for the Laverton and Menzies gold projects and is currently mining at the Second Fortune and Fish gold deposits at Laverton. I'm delighted to have Brightstar's Managing Director Alex Rivera with me today to run through an investor presentation. Alex's presentation will then be followed by a Q&A session. So without any further ado, I'm pleased to hand over to Alex.
Thank you very much, Lucas, and thank you everybody for taking the time to listen to the webinar this morning. So this is an abridged version of the presentation that we released on Monday, which essentially outlines the definitive feasibility study into our Menzies and Laverton gold projects. This, importantly, is a culmination of over 12 months' work from our internal teams and really kind of outlines a stage-taken approach to future growth and production across our West Australian assets. So just for some geographical context, the DFS is relating to our Menzies and Laverton project areas here on the map on the right-hand side. And what it does outline is the production of an averaging 70,000 ounces per annum for a minimum of 5 years, but with significant opportunities for us to extend that mine life and grow that production profile, and really dovetails in with our target 200 aspiration, which is to build a business that can be a plus 200,000 ounce gold producer over the next 4 to 5 years. In terms of the portfolio, we do have 3 million ounces of JORC resources on granted mining leases across the group. The DFS is focused on only our Menzies and Laverton project areas. Importantly, it has focused on a number of open pit and underground developments. So this feasibility study is actually the assessment of multiple mines across both those project areas. So a significant amount of work has gone into outlining this production growth. In addition to our definitive feasibility study for Menzies and Laverton, we do have our pre-feasibility study ticking along in the background for our Sandstone gold project. In terms of the outcomes of the DFS itself, what it did highlight was the 5-year production averaging 70,000 ounces per annum, peaking at 91,000 ounces in 2028. Really, this is the platform to then deliver a Sandstone growth profile, which does see us targeting that plus 200,000 ounce production run rate. Importantly, all the financial figures and production numbers in today's release and the DFS excludes all current production from our operating Fish and Second Fortune mines. So that's important to note. At the moment, we're only, forecasting a 12-month mine life for those two operations. However, we have significant confidence that both those operations will continue. The intent is that we can extend that current mine life further to the right, and we'll see a commensurate increase in the production profile. Similarly, with the study that we showed for Menzies and Laverton, we do think there's real opportunity for us to extend that mine life and extend that peak production profile. So the intent of our business over the next 6 to 12 months and thereafter is to execute on our DFS strategy, increase the mine lives for our existing operations, and also grow the current production profile from the DFS. What that would see is Brightstar's production profile maintaining that 80 plus to 90,000 ounce per annum run rate. In terms of the DFS economics itself, at current spot gold prices, it produces $460 million of project free cash flows for an NPV of $316 million and an IRR of 73%. So a very financeable project, great return on the investment. In terms of the operating costs, it does have an all-in sustaining cost of just under $3,000 per ounce. So again, versus current spot, we're talking $2,000 per ounce margins, which in the history of recent mining in Western Australia is a fantastic margin to be capturing. We do see payback period on the capital within 1 year of commissioning of the mill. So again, this is a very financeable project. We are in a great operating jurisdiction. Western Australia is a great place to be building and operating mines. All of our reserves are on granted mining leases, and almost all the resources are on mining leases as well. It's important to note that these projects are well understood. They've had previous operating history, simply going through an expansion case for existing known deposits. So we've really looked at how do we de-risk this operation and series of operations to the extent that we can. We are looking at having production ramping up from next year onwards. We are looking at a low capex start of operations at Menzies. That's important to note that we do have pre-production capital for this operation of only $14 million. And I'll touch on in a few slides' time the capital strategy there. So we do have near-term low capex production growth. Importantly, in line with the MOU with Paddington that we announced last week, that would see the Lady Shenton open pit mining commencing early in calendar year 2026. In terms of the Laverton mill, we are looking at building a brand new 1 million tonne per annum mill in Laverton to unlock the value of that part of our portfolio. It's important to note that AFID for that Laverton development is not going to occur until later in the year, in line with the debt financing process that's underway and also permitting. We have commenced a debt financing process, which has received significant interest from tier one commercial banks, both offshore and domestic, which really, I suppose, validates the technical work that's gone into the DFS and also the financeability of this project. So we are looking at a potential kind of debt ratio of around about 70% of the capital requirements. The total max working capital requirement is $120 million Australian, and that occurs at the start of 2027. So we've got a significant amount of time here to work out the optimal funding strategy for how we build this operation. Just in terms of outcomes, so we are assessing the mining of just under 6.5 million tonnes of ore across open pit and underground mines for the production of about 340,000 ounces over that period. In terms of the peak funding requirement, as I mentioned, we're targeting max drawdown in 2027. So we do have significant optionality for how we fund this, both with debt and non-dilutionary sources. In terms of the return on investment, this is an important one for us. The NPV on, I suppose, the capital requirements at more than 2.5 times is a compelling opportunity for us. So every dollar we invest into this asset or series of assets, it does deliver over $2.5 back to the business in net cash flows. Importantly, we then are seeking to reallocate that towards our Sandstone asset. We see Sandstone as the flagship kind of tier one asset within our portfolio, and the ability to fund that from the existing and near-term operations is important. And we feel that we've got a real opportunity here to build a plus 200,000 ounce per annum production business that actually helps self-fund a lot of it and certainly a lot of the equity requirements. So we think that's a real unique opportunity in the West Australian goldfields and in the development space to build an asset of that scale with very modest capital requirements. We have done a lot of work on the sensitivity in terms of where we think the gold price is and where it could be. We have run the base case scenario at $4,500 Australian, so that's nearly $600 below spot. And again, it's a very compelling opportunity for us. Annual cash flows there of plus $60 million at $4,500 versus nearly $100 million per annum at current spot prices. So that is a significant amount of capital that we can then redeploy into our portfolio. Just going into some of the specifics here. So as I mentioned, there are 2 key mining areas assessed as part of this DFS. This is a conservative de-risk focus on our development. We are an existing mining organisation. This is not a desktop DFS that we're seeking to be talking about forever. We have got active plans to get boots on ground in the coming months, both on Menzies and Laverton. We've got 2 existing operating underground mines. We are owner-operator, which means we've got all the systems and processes in place, the workforce. Brightstar is a gold mining business. So what we are seeking to do here is simply expand our current operations in a systematic and staged way so that we can sequence both capital requirements and also the deployment of resources. So the DFS looked at 2 key mining areas, Menzies and Laverton. The Menzies processing strategy is around the MOU with Paddington, of which we're negotiating and seeking to document a binding or purchase agreement in the coming weeks. So for that material, then we'll just go down the road to Paddington. The Laverton mineralisation or deposits will be mined and processed through a brand new 1 million tonne per annum mill, and I'll touch on the strategy around that shortly. Important to note that 70% of the production is coming from measured and indicated ounces. We see the opportunity to extend mine life quite materially with further exploration to increase the amount of inferred into that mine plan by converting it to measured and indicated resources. So there is plans in place and underway at the moment. We are currently drilling. We've got I think 4 rigs in the field at the moment across the portfolio where we're seeking to grow these mine lives. Importantly, it is a phased development approach. So we are looking at a low capex Menzies development early in 2026. Importantly, the cash flow that Menzies generates does then provide capital to go in towards the Laverton operations and the group in general. So we think this is a very fundable project. The payback period of 1 year, and delivers $460 million of project-free cash flows over that life of mine. In terms of the catalysts and how do we see this rolling out, the top part of this chart through here just talks about our drilling and ongoing resource work. Essentially, it's business as usual across the group. We are seeking to grow this resource materially and also increase the quality of the resources. So we are targeting a number of resource upgrades across the group. In the short term, we are targeting a resource upgrade at Sandstone towards the back end of this year. We've drilled over 50,000 meters in the last 12 months through there, and we're actually targeting 130,000 ounces, so 130,000 meters of drilling this calendar year. So a significant investment across the portfolio. In terms of project development, really it is first cab off the rank being Menzies. So we are seeking to commence mining in Menzies early in 2026. That is kind of in line with where we're seeking to be making FID at the back end of this year for the Laverton mill. That would then see construction for 12 months and first gold through our own infrastructure at the start of 2027. In order to do that, that would envisage then mining commencing in our Laverton portfolio at Lord Byron at the back end of 2026, so that we're stockpiling all ready for commissioning and processing. Importantly, we are looking at staging the operations of the open pits in Laverton, so we will be starting at Lord Byron and then mining Corkscrew wells sequentially thereafter. Just in terms of Sandstone, look, we do have a pre-feasibility study underway at the moment, targeted for release early next year. That will then flow through into a definitive feasibility study for 2027. We see the opportunity here to be making FID at Sandstone in 2027, which importantly, when we're into that mill construction phase at Sandstone, is when our Menzies and Laverton operations are in full flight. So the capital generated from our near-term operations through that period significantly funds a lot of the capital required to build the Sandstone operations. In terms of the funding strategy, we do have significant optionality with how we do address this. We do have a number of project areas and different capital needs. So it's important to note that we do have a good balance sheet at the moment, $15 million in capital, working capital and cash, and mine stockpiles awaiting processing. We do have another parcel going through the Genesis OPA within the next month. And importantly, the commencement of stoping and material high-grade tons from the Fish underground targeted within this quarter. So that will see a significant turnaround in capital, I suppose, the outflows at the Fish mine in particular versus the significant amount of cash flow that produces. We are approaching steady state for those operations, both Fish and Second Fortune. And it's important to note that all that development capital has largely been sunk. So Second Fortune's been operating for 4.5 years. Fish is now into first ore, which what that kind of represents is past peak funding requirements. The decline's in place, the camp and the site establishment's been completed, and now that operation commences cash flow generation. We do retain the optionality in terms of how we do fund this. Menzies is a low capital approach to how we're going to build this with circa $14 million pre-production capital. Importantly, we are assessing a number of non-dilutive opportunities to fund Menzies, everything from price participation with negotiations with open pit mining contractors to potential modest production royalties and or streaming opportunities. We see Menzies as the near-term cash cow for the business, and certainly the objective for us is to try and finance that. We're actually not outlaying any capital at all to try and build that operation. We then do kind of evaluating opportunities and structures for minimising ultimately dilution and how we do fund the larger Laverton development as well. As part of the DFS debt financing process, we have got significant engagement with the domestic banks as well as conventional natural resource specialist non-bank lenders, so your private equity groups. This is a very fundable project. There are a lot of groups that want to deploy credit and debt money into West Australian gold mining. It is a great part of the cycle and a good jurisdiction to be operating. So we have got significant, I suppose, well advanced in a number of discussions from that perspective. Importantly, it is a validation and endorsement of the technical work that has been done, and we're undertaking a process now to determine the optimal financing strategy. We are looking at making FID at Laverton itself, in about towards the back end of this year, Q4, and really that's in alignment with the debt financing process concluding and also the permitting process coming to conclusion as well. Just looking now at the Laverton hub itself, just for some familiarity, this is zooming into the Laverton portfolio. I'm currently sitting here today at Second Fortune, our existing underground mine up here where my cursor is. We do have two underground mines operating, being Second Fortune and Fish. As I mentioned, neither of those are assessed as part of the DFS that we released this week. They are currently being processed through Mount Morgans. As you can see, putting that material through our own mill does deliver significant benefits, or would deliver significant benefits. Significantly reduced haulage costs and road maintenance costs, significantly reduced processing costs for that material, and would increase the profitability on a per mine basis, on a mine gate basis for the existing operations. We do have ongoing exploration at both of these sites to ensure that we can continue to extend the current operating portfolio. The DFS specifically has assessed a number of things in Laverton. Essentially, it's the near-term open pit mining at Lord Byron, followed by open pit mining at Corktree Well, and a modest underground at Alpha towards the back end of the schedule. The central processing facility here is what we're looking to build. That is the site of our existing processing hub facility. There is a slide I'll touch on in a moment. We are looking at building a brand new mill here as opposed to refurbishing an existing one, which delivers significant capital savings for us and delivers an increased production profile and throughput. In terms of the Laverton hub as it stands, it's got a current processing life of 4 years, averaging just over 50,000 ounces per annum. As I mentioned, Fish and Second Fortune are excluded. It's important to note that they currently operate at circa 35,000 to 40,000 ounces per annum. So if we can continue to extend mine life here with ongoing exploration and development activities, that has the ability to significantly increase the production profile and the profitability of our Laverton operations. We do see a mill out here as being strategic and beneficial for our portfolio, unlocking a number of deposits and pretty exciting exploration targets for us. So the organic growth of our existing portfolio is a key focus for us, as well as also providing the framework for assessing other inorganic opportunities. Everything that we can do in the southeast of Laverton kind of belt or district to increase mine life here just increases the payback on the investment that we will be seeking to make. So, we are very confident with near mine extension from the existing deposits, Corktree Well and Lord Byron themselves specifically, near mine opportunities at the resource areas and advanced, exploration targets, and also inorganic opportunities. Just quickly on our existing operations. So this is Second Fortune and Fish. Important to note that we are owner-operator at these sites. What that means is it is our own fleet and equipment, our own workforce. These are Brightstar employees, systems and processes. This is important because Brightstar is not an explorer trying to become a developer that tries to become a producer. We are an operating business. Everything from the on-site protocols, OH&S, health and safety, HR, the finance function that sits behind it all. These are significant investments that Brightstar's made over the last 2 years that the market doesn't necessarily see, but are crucial for successful operations and growth. And it de-risks our journey from being a small scale producer now to something that we are targeting being a 200,000 ounce producer in due course. Both of these mines are currently open at depth. We are drilling Fish at the moment from surface and are seeking to get an underground rig out here in the coming weeks. We released all reserves at both of these deposits last week. It's important to note that those reserves are predicated only on the ore purchase agreement with Genesis. So they're very much focused only on the near-term mine that's going to go through Genesis. The opportunity for us to recut those reserves through our own infrastructure will provide a materially different cost profile and therefore likely increase the amount of reserves at these operations. So I can appreciate that these reserves do look modest in their own right. The intent being is that it enables us to at least provide guidance about what the operations will produce over the course of the OPA contract. We do see real opportunity for Fish to continue at depth. It's worth noting that the deepest drill hole here is essentially 3 meters at 8 grams per tonne, and that is 200 meters vertically below the bottom of the currently proposed development. So that is a significant extension. We know that there's mineralisation at depth. We know the systems are still live. It's the same alteration, the same morphology, and essentially the same widths and grades that we're seeking to be mining up through here. So we do know that this ore body is open at depth, hence why we are drilling it at the moment. These drill holes are currently underway. We've completed the RC pre-collars and the diamond tails are underway, and we'll be getting an underground rig out here in the coming weeks. Just looking now at the 2 open pits being Lord Byron and Corktree Well on the next 2 slides. So Lord Byron is the first mine area that we're seeking to be mining in Laverton, circa 300,000 ounces of resources. It's important to note that the reserves that we've declared here is really a stage 1 process. This is where we are putting a line in the sand or a flag saying, hey, this is what we think is stage one today, but there is a very real likelihood that these mines continue with further cutbacks. So the pit designs are done on ore reserves only. If we run these pit designs on measured, indicated, and inferred resources, they get a lot larger and pull a lot deeper. So it's important to note that with ongoing exploration, it's very likely that these deposits will grow. In terms of what we have declared here, we've got an ore reserve of just under 60,000 ounces. Again, these are optimized at $3,500 Aussie. That gives us a 2-year mine life here at Lord Byron. Important to know that every year, every additional year or quarter that we can add to production here adds a material benefit to our mine life and the overall the economic benefit of our development scenario here. All-in sustaining cost for Lord Byron, $2,911 per ounce. So good margins versus current spot. Average production contribution of about 30,000 ounces per annum, just to give an indication of that natural mining run rate. We do see real opportunity for this to increase. The ore body at depth here is plus 30 meters wide. So we're able to get the benefit of larger fleet and equipment, 150 to 200 ton class fleet, enables productivity and that is efficiencies of scale. Importantly for us at Lord Byron is that it is co-located with the Fish mine. What that means is that a lot of the infrastructure and the capital that we've spent at Fish already as a sunk cost is a free kick for Lord Byron. So the site establishment, the haul road upgrades that we've spent money on, the camp and the site establishment works, that's all money that we've spent that we don't have to spend for a Lord Byron startup. Again, it's probably not appreciated with the capital we spent at Fish, but when we get to Lord Byron, that's a significantly de-risked approach to how we start operations here. In terms of when we're seeking to commence mining here, if we do make FID for the Laverton build of the mill in Q4 of this year, then we'll be seeking to be mining this early in the start of the 27 fiscal year. Essentially, that gives us circa 6 months of mining and stockpiling of ore ahead of commissioning the mill. The Corkscrew Well deposits are located north of Laverton, very similar to Lord Byron in the sense that this is a bulk mining opportunity. What we've done is declare reserves on a relatively modest component of it, essentially as this stage one process. So again, similar with Lord Byron, we see real opportunities for this to continue. 76,000 ounces in the stage one ore reserve. That's essentially about a 2-year mine life based on the proposed mining rate. Plus 95% recoveries across all ore types, across the different lithologies at Corkscrew Well. Slightly larger operating strip at 11:1, but this is carried by the high grades. Important that these are diluted mine grades that we're referencing all through the documentation here. And it delivers an all-in sustaining cost of $2,500 an ounce. That's half the current gold price. So we are very confident that Corkscrew Well is a very profitable portfolio contributor, and there's also a lot more upside and mine life to generate here. Just changing focus now to the actual mill itself. So this is what we're seeking to develop. This is a 1 million ton brand new 1 million ton per annum CIL plant. Important to note, this is very conventional. We're looking at a fixed 3-stage crushing circuit, 2.5 meg ball mill, a coarse 106 micron grind, conventional leaching tank system with gold doré on site. This does deliver plus 90% recoveries across all ore types that we're seeking to process. So very conventional, very well understood. This is as basic as it gets for an Eastern Goldfields development. Importantly, we are looking to build this on the existing mill site. That gives us a number of advantages using the existing infrastructure, using the existing site. So we do get material capital savings. For example, being able to reuse elements of the existing processing plant, but also areas of non-process infrastructure. So the in-pit tailing storage facility that's in the adjacent open pits, the ROM pad, the haul roads, etc., water ponds. This is all capital that we don't have to spend and gives us a really good head start there. We are able to utilize the existing licenses and permits are in place. So again, we have a very streamlined approach to permitting and approvals here. We are targeting FID in Q4 of this year. And it's important to note the peak funding requirement for the business is actually not for more than a year after that. So that's essentially when this mill is commissioning and ramping up is when the peak funding is requirement. So we do have a significant period of time here to finance this in the most optimal manner, so that when we do go through commissioning and ramp up, we have a fantastic balance sheet and we're a cash flow producing asset business. We'll have a number of mines in operation. Really kind of de-risks that approach to commencement of operations. In terms of the processing plant itself, look, we did do it with a lot of work into utilizing the existing infrastructure. It's important to note that there were a number of, I suppose, bottlenecks in the existing in the mill if we were seeking to take it to a million ton per annum mill throughput that we're assessing here. So that it was a much better outcome to look at a brand new one versus changing out pumps and power reticulation, tank sizes, brand new comminution circuit, etc. It did deliver a much better outcome. Given the project life, the gold price where it currently stands, and the likelihood for significant mine life extension in Laverton, we've deemed that it was more appropriate to look at brand new infrastructure that we're certain is going to have, a 10-year mine life potential in it versus trying to refurbish something that's not fit for purpose. So now changing tack a little bit to our Menzies hub. So just for some context, Menzies is located 130 kilometres north of Kalgoorlie along the sealed Goldfields Highway. We do have an existing resource here at Menzies of just under 600,000 ounces of resources. Menzies is a really great, I suppose, jurisdiction for us. It's got a storied mining history, 800,000 ounces mined historically at nearly 20 grams per tonne. So it's got a great high grade, I suppose, structure to this ore field. We have announced an MOU with Paddington where we are seeking to process the open pit material through that mill. That is 90 kilometres to the south along the Goldfields Highway. So very easy to truck that material down the sealed highway to Paddington. Importantly, we are looking at a number of developments here, really underpinned by two main mining areas, being the Lady Shenton open pit, kind of in the middle of the Menzies Greenstone belt of our project area, and the Yandega underground. We are looking at Yandega actually being processed through our Laverton mill down the track, just due to the grade profile of it and I suppose trucking costs and processing costs. It delivers a better economic outcome for that high grade material to go around to Laverton. We are looking at mining of over 100,000 ounces of open pit material here over about a 3-year mine life. So great cash flow generation for us. Circa $14 million capital required to get this into operation. And as I mentioned, we think there's a real opportunity for us to fund that with very limited capital actually going out the door from Brightstar. So we can fund that from non-dilutionary sources. And it delivers $140+ million of free cash flow over those 3 years. So that is a significant return on investment for us here. This is a very de-risked, low-risk approach to generating significant cash flow and near-term gold production that is very additive to the, I suppose, the existing Laverton production portfolio and the near-term Laverton developments. There are a number of very modest open pits we are looking at mining around the Lady Shenton area, all located within 1 to 2 kilometres. So additive at the end of the mine life. We'll just go and rip those out. Just zooming in on Lady Shenton itself, the actual deposits comprising the Lady Shenton open pit system, 273,000 ounces of resources. Again, similar to Laverton, this is very much a stage one approach. So the stage one ore reserves here are 80,000 ounces. Again, the pits are designed on 3,500 Aussie optimization price, and the pit designs themselves are done on ore reserves only. So significant opportunity again for this to increase over the course of its mine life. Produces about 30,000 ounces per annum from an all-in sustaining cost perspective, a little over $3,300 Aussie per ounce, slightly higher due to the nature of the third-party milling arrangement. You are paying increased haulage costs down to Paddington, plus the proposed processing cost rate there, paying a third-party margin. So it does deliver that slightly higher sort of all-in sustaining cost. But again, in terms of what we invest versus what we actually get back, it's a significant contribution to our business. Lastly, in Menzies, Yandega underground mine that we're proposing. We are currently drilling at Yandega at the moment. These drill traces you can see on this oblique section is where we are currently drilling. We are seeking to grow this mine life and convert all the existing resources into reserves as part of a mine plan optimization work. We are targeting FID here after Lady Shenton commences. So we get Lady Shenton into operation, we get the site established and the camp in place, and then we can develop this sequentially. In terms of opportunity here, we see real opportunity for extension at depth. It's important to note that this was actually mined down 600 meters over 100 years ago. So it's got a very kind of high-grade historic mining history to it. We recently announced a hole that we hit 16 meters at 8 grams per tonne, kind of where my mouse is here, below the proposed current development. So that is at depth, that's extensional to the current development. So that is an indication of likelihood for mine life extension as we seek to drill this out and take it through to towards operations. It's important to note that we do have the workforce for our existing operations up here at Second Fortune and Fish that we can actually leverage upon for not only feasibility study work, permitting approvals, mine design and scheduling, but also the future operations here. Should Second Fortune or Fish not have that mine life extension, then we do have an underground mine here we're looking to commence within the next 12 to 18 months that is very much fit for purpose for the existing fleet, equipment and personnel we have up here in Laverton. So we're thinking that we can resource Yandega entirely internally from within Brightstar's operating business and essentially cash flow fund it from operations. So that's the last of the slides on the DFS. I do have a couple here on sandstone, which I will touch on. It's as I mentioned, kind of an important part of our asset base. We do think this is probably the flagship development opportunity for us. Obviously, a little bit of news in the press earlier in the week regarding a proposed potential transaction with Ormonde, which I'll mention in a moment. Just looking at sandstone itself, there were two real key reasons why we liked this district and why we were keen to kind of move away from just our Menzies and Laverton portfolio last year with that M&A. From a district scale perspective, within this 100-kilometre radius around sandstone, there's not one operating mine. There's no mid-tiers, there's no majors. But within that same 100-kilometre radius, there's 6 to 7 million ounces of gold owned and controlled by ASX junior companies or private companies. So it really is a unique opportunity in the Eastern Goldfields or the Murchison to have significant level of endowment, but have no existing operating mines and no mid-tiers or majors. So it really presented as an opportunity for consolidation and roll-up, which is what Brightstar sought to do. So last year we acquired Alto Metals, which delivered the Sandstone project to us, and we acquired the Montague Gold project out of Gateway Mining, contemporaneous with the Alto deal. That delivered us 1.5 million ounces, in our view, the best part of the whole system being the Sandstone project. So we think there's a real opportunity to continue to build a very large scale business here. The second real reason why we like sandstone was due to the exploration potential and upside. So when you look at the exploration history across both these project areas and indeed the district, it's really lacked that systematic exploration. It's lacked the balance sheet and the constant work to actually explore here. The last time it was mined in 2005, the gold price is well less than $1,000 per ounce. So the gold price is up 5x. The previous owner of those operations down at Sandstone, which was Troy Resources at the time, only had a very modest oxide-only bore mill. They couldn't process any hard rock. So there's very limited exploration at all at depth. So what that means is that this package of ground just hasn't had the work done on it whatsoever. That's why we're so excited about our drilling. We've got 80,000 meters of RC and diamond drilling to do this year. We've put out a number of results over the recent months and we'll continue to do so. And it really, for us, is super exciting. We see a real potential for our existing portfolio to be materially larger than the current resource base. It's important to note that this is all on previously disturbed ground. There's the sealed highway that goes from Leinster through to Mount Magnet through Sandstone. So it is a great part of the world for building infrastructure. If we were to assess building a mill out here in due course, it does provide that backdrop or that framework for assessing further inorganic growth options as well. So we are very excited about the organic growth opportunity here, but also the potential to build a business of significant scale. This is just zooming in on the Sandstone project area itself. We've put out a number of results over the recent months, and what we like a lot about Sandstone is just the different mineralizing systems and opportunities for us here. Everything from granodiorite intrusions to BIF-hosted mineralization, quartz veining in the mafic and ultramafics and the contacts. Look, it is a very structurally complex greenstone belt, bound by two regionally significant shear zones. That's very exciting from an exploration perspective. So we see real potential for growth here. 90% of our resources are in the top 150 meters. It is very rare to have this level of endowment in the Eastern Goldfields of Western Australia and to have very limited drilling at depth. A lot of these deposits, the majority of these deposits are open and just hasn't received the exploration. So we are very excited about the opportunity to increase the quality of the resource, but also increase the size of it quite dramatically. Just touching on briefly the potential proposed Ormonde transaction, which was announced earlier this week. Look, all I can say on that is that mutual due diligence is proceeding. negotiations is proceeding, so there's no guarantee or certainty of a deal. However, we are really excited about the opportunity here. For context, Oryman's ground is encapsulated entirely within our portfolio. They have 900,000 ounces of resources, and importantly, the old mill site for where Troy Resources mined and operated. So, a potential transaction here delivers resources, some great open pit resources that would be perfect to go through any mill in the district, but also key licenses, permits, and infrastructure. So something that we quite like the look of. We disclosed late last year that we put a JV opportunity to Oryman. We think ultimately there's a lot more consolidation that should happen in Sandstone. That will be for the betterment of all sets of shareholders and the market in general. If we're successful here, ultimately with a proposed Oryman transaction with resource growth for our existing portfolio, I'd love to have a business here in Sandstone that's underpinned by 3 to 4 million ounces of resources on mining leases. That is, near-term development. We're looking at FID in 2 years' time. That can be funded from our near-term operations in Menzies and Laverton. That opportunity, in my view, doesn't exist anywhere else in the Eastern Goldfields of WA. That is a very unique set of assets, underpinned by what would be a tier one flagship operation in Sandstone. That would underpin a significant valuation for this business in the future, but also probably importantly would be a very opportune target for the mid-tier sector, which is looking for growth opportunities. So we're excited about the opportunity that we can build out here in Sandstone, and that probably dovetails in with how we look at quantifying the size of the opportunity. Look, we've kind of run a matrix of what a mill sizing throughput looks like. We previously identified that 3 million tonnes was probably the right number. Look, we're doing work at the moment as part of the pre-fees. What if we went larger? What does that actually deliver? Lowering the cut-off grade, increasing the amount of tonnes that would be optimised into mine plans. You can see here we're starting to look at something that could be quite a substantial set of I suppose processing district with a significant resource base behind it. Again, this is very much a unique opportunity in Western Australia. Larger opportunities, like the De Greys, obviously getting acquired by the mid-tiers and the majors. De Grey, Spartan, for example. We see the opportunity here for something that probably rivals the potential scale of some of those potential operations. We do envisage a pretty aggressive 2-year period here ahead of us in terms of going through a pre-fees into a DFS. Contemporaneous, we are doing all our approvals and permits to ensure that when we get to FID, or when we get to 2027, we can make FID. And again, when we get to construction and development, this is when our proposed Menzies and Laverton operations are in full flight and are producing that $90+ million of free cash per annum. Now that essentially provides the capital requirements to build this mill. That's certainly what the aspiration of our business is. And just lastly, just a bit of a platform or an outlook. Look, we do have existing operations. We are looking to develop a number of other operations, clearly Menzies being the first cab off the rank. These operations do deliver great cash flow for our business. Over 5 years, $460 million of net free cash to us is significant. Importantly, this is a very de-risked and very conservative approach to commencing operations here. We've been very conservative in the way that we want to build this, the way we want to sequence the capital requirements, how we sequence the resourcing of this. We're never looking to build multiple things at the same time. How we deploy people and resources is important to us, and there's a lot of thought that's gone into this development scenario. We do have a very aggressive exploration development program, 130,000 meters of drilling this calendar year, and that is only growing year on year as we get into further cash flows and the scale of the asset base increases. Look, we do continue to assess accretive strategic deals all the time. That's probably a key dovetail into that Oryman concept. We are very focused on our existing assets, building Menzies, building Laverton, but the opportunity to try and do something that is clearly synergistic, clearly accretive, and a great outcome potentially for Brightstar shareholders and Oryman shareholders is very logical and it needs to be assessed in its own right. So we are continuing to look at a number of things that do make sense as we seek to grow our business towards this target 200 strategy. So I'll leave it there, Lucas, and happy to take questions.
Great presentation, Alex. There's a couple of questions that I think you've probably already covered the answers for that have come through during the course of your presentation in relation to the benefits of building the new plant in Laverton on the side of the old one. and also in relation to the Ormonde proposed Ormonde merger. So I'll move on to a question, and I suppose it's very general. I mean, what are some of the growth opportunities which you are most excited about?
Yeah, look, it's probably a two-pronged answer to that question, Lucas. For us, we see growth in two ways. It's near mine or near-term mining growth, and it's how do we grow the portfolio and kind of that medium term, how do we build a business of scale. So in the short term, we've delivered something that we genuinely feel is very fundable, de-risked, and conservative. Important for us that the upside is the near mine upside around the DFS. So looking to grow the proposed mining inventory at Lord Byron and Cork are absolutely no-brainers to extend the mine life for us. Again, every ounce that we can produce through that mill just makes that investment that we're building into that infrastructure a lot more logical. So near mine extensions for those operations, also kind of organic growth in that Laverton portfolio, again, seeking to grow that production profile. If we can target areas of grade, the extension of fish, for example, delivering high-grade feed into our own mill is a massive game changer for the economics and the production that we've outlined here. If we can be delivering 20% of the ore feed through our mill being high-grade underground, now there's a material shift in the cost profile, based on the ounces produced. So that's a key focus for us. And I suppose more broadly is just the exploration upside across the portfolio, across the business. A lot of the assets that we've acquired over the last 2 years were acquired due to the upside. We've seen lack of systematic exploration, gaps in exploration methodologies, things that we can actually, with our team and with a capital base, really unlock value. Sandstone's a great example of that. I love to think that in the opportunity that we can see what we can deliver over the coming years.
Terrific. I appreciate some of this is going to be a bit difficult to answer accurately, but based on current production levels, operating costs, and gold prices, can you provide any guidance regarding likely cash generation over the balance of the calendar year from the Fish and Second Fortune operations? And will this cash be sufficient to fund this year's exploration and development activities?
Look, we have not put out financial guidance, I suppose, in terms of that production profile. What we have done is put out reserves. The reserves are economic on $3,500 per ounce optimization price. That gives you kind of an indication on the level of profitability versus, I suppose, a break-even gold price. The discretionary spend of the business, being the exploration and development costs, feasibility study work, etc., is aligned to the profitability of those operations. So what we're seeking to do is have the cash flow that generated from those operations married up with value accretive opportunities. So we're not in a cash build phase by any stretch for this business. All the money we make from those operations gets redeployed into our business so that we can grow overall the value of this business. So I suppose that should kind of provide some context that the cash flow generation, the positive cash flow that the two operations produce, gets recycled into the exploration. And those budgets, obviously, they're live, they're dynamic, and they are adjustable to, I suppose, align with the cash flow generation.
Excellent. When do you think you might be in a position to complete the funding for the process for the CapEx described in the DFS?
Yeah, look, that's a process that's ongoing. Look, we're not looking to be making FID on that for a number of months. So we do have a significant period of time with how we do finance the overall CapEx for the build. As I mentioned, we are running a debt financing process with commercial, domestic, and offshore banks, but also a number of non-bank private equity, natural resource specialist funds as well. So we think there's real potential for that 70+% of the capital requirements to be debt driven. This project is not sensitive to the debt profile. So with a 1-year payback, with the cash flow that it generates, this is a very fundable project. What we are seeking to do is have the optimal financing partner. We would love to be kind of partnering with a group that gives us that financial flexibility. We are focused on trying to finance this without mandatory hedging requirements. We want to make sure that we're retaining as much flexibility as possible in our business so that we continue to pursue growth opportunities at the same time. So that kind of aligns to that debt financing process taking a number of months from now. We are targeting FID in Q4 of this year, which aligns with that process. So I suppose that gives us the opportunity to finance this appropriately. We are looking at a number of non-dilutionary funding mechanisms, partial asset sell downs or selling non-core assets. Things like streaming and royalty opportunities are very attractive as well. So we have a number of, I suppose, opportunities for us to fund this in the most optimal manner for shareholders. And that's kind of a key focus for the board, who are all, very material shareholders in this business.
Thanks, Alex. I'm mindful of time, and we've got a very large audience on the line, so thank you for everyone for attending. That seems to cover the majority of our questions from the audience. If you have asked a question which has not been answered, we will attempt to answer them offline. Or if you have any further questions, please feel free to forward them to info@corporatestorytime.com. Alex, do you have any final comments?
I would just like to thank all the shareholders for their support and the market in general. Look, this is a very dynamic business. We can appreciate that there's lots of balls in the air. I suppose the overarching reality of our company is that we are conservative by nature. There is a significant, experienced team of mine builders that run the operations here. Like, we've been very focused on delivering a study that is real, is deliverable, fundable. We actually execute on that. When we can look back in 5 years, we can say, hey, those CapEx and OpEx numbers were correct because of the work that's gone into it. That is really important for us to be able to deliver what we say we can deliver. So we are excited about building this business. I think that's a very key objective for us in the near term, is to grow our production and then trying to unlock the value in that sandstone portfolio. I can't underscore how important that is for us. I genuinely don't see another opportunity in the Eastern Goldfields or in WA on the ASX in terms of the developer space where you could potentially have a business with 3, 4, 5+ million ounces in a development scenario. They just don't exist. So we are very excited about that opportunity. That is a genuine flagship tier 1 asset for us. What excites me personally is the ability to fund that with our near-term operations. We've got existing operations now. We get Menzies and Laverton to defer the cash flows. That really does deliver a de-risked approach to funding and building sandstone, as quick as we can. I think that's what all shareholders want us to do.
Thanks very much for attending, and thanks for such a thorough rundown, Alex.
No worries. Thank you, Lucas, and thank you all for attending. Appreciate it.